Fear of losing money is one of the most common problems in trading. It affects beginners, it affects intermediate traders, and even experienced traders feel it at times. This fear shows up quietly. It makes you hesitate before entering a good trade. It makes you exit too early. It makes you avoid valid setups. And sometimes, it makes you stop trading completely. In this video, I want to explain how to overcome the fear of losing money in trading. Not by ignoring it, not by pretending to be confident, but by understanding where this fear comes from, why it feels so powerful, and how professional traders learn to manage it step by step. If you stay with me until the end of this video, you will understand why fear of loss is natural, why fighting it usually makes it worse, and how you can slowly reduce its impact on your trading decisions. This video is designed to be watched calmly, from start to finish. Each part builds on the previous one. If you are serious about trading psychology and long-term consistency, consider subscribing to Bull Mindset. This channel is about helping traders think clearly, stay disciplined, and build emotional control over time. Now let us begin. Fear of losing money does not mean you are weak. It means you are human. Money is not just numbers on a screen. Money represents safety. Money represents effort. Money represents time. When money is at risk, the brain reacts. This reaction happens automatically. The brain's job is to protect you from pain. Loss feels like pain. So when you trade, the brain tries to keep you safe. It tells you to avoid risk. It tells you to exit early. It tells you to wait for more confirmation. This is not a flaw. This is biology. The problem begins when traders treat this fear as something that must disappear. They try to force confidence. They try to suppress emotions. They tell themselves they should not feel fear. This creates conflict. The more you fight fear, the stronger it becomes. Professional traders understand something important. Fear does not disappear. It becomes manageable. The goal is not to remove fear. The goal is to trade without letting fear control behavior. Fear only becomes a problem when it changes your actions. Now let us understand why fear of losing money is so strong in trading. One reason is uncertainty. In trading, you never know the outcome of the next trade. No matter how good the setup looks, the outcome is unknown. The human mind does not like uncertainty. It wants guarantees. But the market never gives guarantees. So the brain reacts with fear. Another reason fear becomes strong is poor risk perception. Many traders risk more than they can emotionally handle. Even if the amount looks small mathematically, it may feel large emotionally. When risk feels too big, fear dominates. Professional traders choose risk levels that allow calm thinking. They do not try to be brave, they try to be stable. Another reason fear increases is emotional attachment to money. When traders think about bills, goals, or recovery, pressure increases. Pressure amplifies fear. Professional traders separate trading capital from personal emotion. They treat trading money as business capital, not personal identity. Now, let us move into real trading situations. Imagine a trader watching a valid setup form. Everything matches the plan, but fear appears. The trader thinks, what if this loses? They hesitate. They wait. Price moves in the intended direction without them. Later, regret appears. This regret reinforces fear. The trader now fears missing out and losing money at the same time. This emotional loop is exhausting. Now imagine another trader. They see the same setup. They feel fear. But they enter anyway, calmly. They already accepted the loss before entering. If the trade loses, it is expected. If it wins, it is just one outcome. Same fear, different response. The difference is preparation. Another example is exiting trades early. A trader enters a trade. Price moves slightly in profit. Fear of giving back profit appears. The trader exits too early. Later, price continues to the target. The trader feels frustration. This frustration increases fear in future trades. Professional traders accept that profits fluctuate. They do not try to protect every small gain. They trust their process. Another example is avoiding trades after losses. A trader loses a few trades. Fear increases. They stop taking valid setups. They want to avoid more pain. But avoiding trades prevents recovery. Professional traders expect losing streaks. Expectation reduces emotional shock. Now let us talk about how to overcome this fear step by step. The first step is acceptance. You must accept that losses are part of trading, not occasionally, but regularly. Even the best traders lose trades. When you truly accept this, fear reduces. Acceptance is not saying you like losses. Acceptance is saying you expect them. The second step is defining risk clearly. Fear thrives in uncertainty. If you do not know exactly how much you can lose, fear will grow. Before entering a trade, know the maximum loss. Accept it mentally. If you cannot accept it, reduce the position size. This single adjustment can dramatically reduce fear. The third step is reducing position size. Most traders try to overcome fear by increasing confidence. Professionals reduce fear by reducing risk. Smaller risk equals less emotional pressure. Less pressure equals better decisions. Trading smaller is not weakness, it is intelligence. The fourth step is shifting focus from money to execution. When money is the focus, fear increases. When execution is the focus, fear reduces. Define success as following rules, not making money. This mental shift takes time, but it works. Now let us talk about mental frameworks professionals use. One powerful framework is probability thinking. Each trade is just one event in a long series. No single trade matters much. When you truly understand this, fear loses intensity. Another framework is process identity. Professional traders see themselves as disciplined operators. They are not trying to win trades. They are trying to execute correctly. This identity reduces emotional attachment. Another framework is neutrality. Professionals aim to stay emotionally neutral. They do not celebrate wins. They do not mourn losses. They stay steady. Now let us talk about practical exercises you can apply. One exercise is pre-trade loss acceptance. Before clicking buy or sell, say to yourself that you accept the loss. If you cannot say it honestly, do not take the trade. This exercise trains emotional honesty. Another exercise is post-trade review. After a trade, review behavior, not outcome. Did you follow your rules? Did you manage risk? This reinforces discipline. Another exercise is fear journaling. Write down what you feared before the trade. Then compare it with what actually happened. Over time, you will see that fear exaggerates reality. Another exercise is intentional exposure. Trade small size intentionally. Allow yourself to experience losses without panic. This slowly retrains the brain. Now let us slow down and connect everything. Fear of losing money is natural. It does not mean you are not meant for trading. It means you care. The goal is not to remove fear. The goal is to prevent fear from controlling behavior. Professional traders still feel fear, but fear no longer decides for them. If this video is helping you understand your emotions better, consider subscribing to Bull Mindset. This channel is dedicated to trading psychology, emotional control, and long-term consistency. Let me leave you with a final thought. Fear does not disappear through confidence. It disappears through preparation and acceptance. When you learn to accept losses calmly, trading becomes much clearer. Trade calmly, trade with discipline, and think long-term. I will see you in the next video.